So in this video, I'd like to cover what I call the 8 golden rules for stock investing. And the reason I decided to make this video is because in the last 10, 20, 30, 50 years, stocks have been the best way to build your wealth. They have outperformed all asset classes, bonds, real estate, and commodities. And I built my wealth in the stock market. But the shocking thing is that there are people out there who actually lose money investing in stocks. And when they lose money, they say, oh, because the market's rigged. They've got something to blame. Or they say it's because I've got bad luck. They give excuses. Or they say that it's because the market's really risky. Wrong. If you lose money in the stock market, it's not the stock market's fault. It's you, right? Now, I always say that the stock market is not risky. It's only risky if you don't know what you're doing. It's only risky if you violate these 8 golden rules. It's kind of like, yeah, swimming is risky if you don't know how to swim. Driving a car is risky if you don't follow the traffic rules and take driving lessons. If you learn how to drive, you learn how to swim, swimming and driving isn't risky. In fact, it gets you to where you want to go, achieves your goals. Same thing with the stock markets. So in this video, I'd like to share with you, again, what are the 8 golden rules. And if you follow these 8 golden rules, you find that investing in the stock market is one of the most consistent, one of the most sustainable ways to build your wealth in a low-risk, stress-free way. You know, I've been in the markets now for over 30 years. I started at 17. I'm now 48 years old. But for the first 10 years, I really did not know what I was doing. I made all the stupid mistakes that most investors made. I broke these 8 golden rules. And did I make money? Well, sometimes. But whatever money I made, I couldn't keep it. It was not sustainable. I'll lose it back to the markets. And I say, oh, you know, because my luck changed, right? So I made money, I lost money, I made money, I lost money, and went around in freaking circles, right? Until one day I got frustrated. I said, you know what? This can't go on. I have to learn how the market works. So it was that moment that I realized that I had to first invest in my own financial education. So I read all the books I could read, and I started to model the best investors in the world. People like Peter Lynch and Charlie Munger and Warren Buffett. I read all the books on technical analysis, fundamental analysis, you name it, I read those books, and I began to, through trial and error, see what worked. And that's how I developed my system of investing, which I call value momentum investing, that's allowed me to beat the markets over the long run. So in this video, I'm going to summarize the 8 golden rules of this investment system, that if you follow it, you can achieve consistent profits investing in the stock market in a stress-free, low-risk way. So if you're ready, let's begin. Now, a lot of people always ask me, and sometimes they post in the comment section, Adam, why are you always so optimistic? Why are you always so bullish? And why are you not worried when the market goes down? Aren't you worried that we could crash? No, because I know rule number 1. And rule number 1 is that the stock market always goes up eventually. The market always goes up in the long run. And in fact, the stock market doubles every 9 years on average. And again, this is a fact. So if you take a look at the stock market, and when we talk about the stock market, we're referring to either the Dow Jones Index or the S&P 500 Index. Now, I usually prefer to use the S&P 500, but in this case, I'm showing you the Dow Jones Industrials Average because it's got a longer history of over 120 years, whereas the S&P 500 has a shorter history. But more or less, they both move together, okay? So if you take a look at the last, again, 120 years, you can see that the market always goes up. And people are always concerned. They say, Adam, you know, what if I invest my money now and the market crashes and there's a recession that could be coming, there's this ongoing war, and there are all these problems, there are all these uncertainties. You know, I'm going to wait for there to be no more problems. Now, that ain't going to happen, okay? Now, let me ask you this question. In the last 120 years, was there always something to worry about? Yes, there was always a problem out there. Now, what happened back in 1916? We had World War I. In 1929, we had the Great Depression. In 1945-46, we had World War II. In the mid-60s, we had the Cuban Missile Crisis. In 74-75, we had also ultra-high inflation. We had oil prices doubling and tripling, and people calling for global depression. Sounds familiar? In 87, we had a stock market Black Monday crash. We had the Asian financial crisis, 98, 2000 dot-com crash, 2001 9/11. We had the 2008 US financial crisis. We had the S&P downgrading the US government debt. We had the European debt crisis. We had the US government shutting down 3 times. US-China trade war, COVID-19, right? So despite 2 world wars, a dot-com crash, a financial crisis, a pandemic, what happened to the stock market? The stock market always found a way to go up. So the question is, 5 years from now, 10 years from now, 20 years from now, will the stock market be a lot higher than today? Of course. It's a fact. It will always go higher. Now the question is why? Why do stock prices always go higher? There's one reason and one reason only. It's because of earnings. That's right. Now remember that when you buy a stock, you're buying an ownership in a business, in a company. And when you look at the S&P 500 or the Dow Jones, it's a basket of many, many companies. Now ultimately, the more profits or the more earnings the company makes, the more the businesses are worth. And profits go up and down in the short term, right? For example, look at this chart. Profits fell during the Great Depression. It fell during the pandemic, right? It goes up and down. But in the long run, company profits always go up. Company profits always go up because over time, companies keep raising the prices of their goods and services. It's called inflation. It's like when I was a teenager, Nike shoes were $20 and it was really expensive. $20 for Nike shoes. Wow, right? Now a Nike shoe is like $200 to $400. And Nike is making more money today than 30 years ago. And you'll make even more money 20 years from now. And the other thing is because over the years, there's more and more people, right? Population increases, wages rise. So people make more money today than 30 years ago. They can pay more for a Nike shoe. They can pay more for a Big Mac. So that's why company profits always go up over time. And as companies make more money, the businesses are worth more and more, and their share prices always go up. So, people say, Adam, but I need the Fed to pump in liquidity for the market to go up. That's absolute rubbish. Yes, that's true for companies that don't make money. They are propped up by the Fed quantitative easing. But those are not the companies that I invest in. I invest in great companies that make money. I invest in the index. And for those, we don't need the Fed. We don't need all this liquidity. As long as McDonald's makes more and more burgers and fries, Nike sells more and more shoes, the stock price will keep going up. So on average, company earnings grow at 8% per year on average, which means company earnings double every 9 years. And hence, that is why stock prices or the value of the businesses doubles every 9 years as well, which means on average, it goes up about 10 to 11% a year. Now, it doesn't mean that it goes up every single year, of course. In reality, some years the market goes up more than 10%. Some years it goes down, it goes up less than 10%, and some years it even goes down. So if you take a look at, for example, the last 71 years, you can see that there were years the market went down, but not that often, right? The market went down 18 out of 71 years. So that's 26% of the time. But 52 years out of 71, the market went up. That's 73% of the time. So yes, if you invest for only 1 year, you buy in January, you sell in December, you could lose money, right? So for example, if you did that in 1953, you would have lost money. If you did that in 2018, you would have lost money. If you invest for just 1 year. But if you invest for a longer period of time, if you invest for, say, at least 5 years, or you invest for 10 years, or if you invest for 15 years, what do you realize? You can never lose money. You can never lose money when you invest over a longer period of time. Why? Because the gains from the up years far outweigh the losses from the down years. So it is impossible to lose money in the stock market if you hold it over a longer period of time. And so because of this fact, I've got no fear when my stocks go down temporarily. When my stocks go down, I happily buy more because I know it's always going to go up. And I'm always going to make money if I buy companies that actually make money. So that's rule number one. So this brings us to rule number two. So rule number one, we said that the market always goes up, right? But rule number two is that in the short term, in the next 1 week, 1 month, 6 months, or even 1 year, no one can predict for certain where stock prices are going. And if you look at the news, you watch videos, you can see that some people will say, okay, this year the market is going to go all the way down, crash 50% or crash even 80%. And you got more optimistic people like me who says, no, the second half we're going to rebound, make back most of the losses, or even end up with a gain for the second half of the year. Now, who's going to be right? I don't know, right? So sometimes I'm right, sometimes I'm wrong. But historically, I'm right 73% of the time, right? Why? Because you saw the chart, 73% of all years end with a gain. So if I say the market's going up, guess what? Statistically, I'm going to be right 73% of the time. But there'll be a 26% or 27% of the time that, I'm going to be wrong, right? So you never know when are those times. So again, no one can agree where prices are going to go in the short term. Why? Because there are too many moving parts. There are too many variables. It is the news and the emotions that drive the market price in the short term, not the value of the underlying business. So the question is this: can you predict tomorrow's news? We can't. Can you predict how millions of people will react emotionally to the market in the next 1 day or 1 week? We can't, right? So if you think you can predict the market for certainty, it's like thinking that you can predict the weather or you can predict your wife or husband's mood the next day. It is impossible. So all we can do is we can just make probabilistic guesses based on reading the price action, based on understanding historical patterns. So if you've been watching my previous videos, you know that based on price action, every time the market drops 90 degrees, when there's extreme fear, the market bounces back, which happened, right? You can see here, extreme fear, market bounces back, extreme fear, market bounces back, extreme fear, 90 degrees, market bounces back. That's based on price action, based on reading the historical patterns, right? But how long will this rally continue? It's anyone's guess. If you look at the charts right now, you can see that we are on a downtrend, right? So on a downtrend, the probability is that prices tend to go lower. In the last few days, we had this rally in the market, but based on chart patterns, you can see that it's going to hit this resistance level, and people say, hey, it's going to go all the way back down, which it could be the case. But at the same time, it is also possible that with new news or new developments, it could break this resistance and resume into a new uptrend. So no one really knows. Markets can be totally irrational in the short term. So be prepared for anything. Could the markets drop 80% this year? Everything is possible. Could the markets go up 80% this year? Everything is possible. Now, here's the good news. The good news is that it doesn't matter whether I'm right or wrong in the short term. It doesn't matter whether markets go up or down in the short term. It really doesn't matter. Why? Because if the market goes up in the next 6 months, then it's good, right? Because I look like a genius and my portfolio looks really beautiful, okay? But if the market keeps dropping in the next 6 months, it's also good news. Why? Because as an investor, I'm holding great companies, and lower prices means that I get more chance to buy my great companies at even bigger discounts. Which means that when it goes up eventually, because it always goes up eventually, I'm going to make even higher returns. So as an investor, you got to understand that it is a win-win situation. If the market goes up in the short term, your portfolio looks beautiful. If the market drops in the short term, you get a chance to buy more shares at a bigger discount. But you may say, but Adam, if it drops, don't I lose money? No! If you're holding good companies and you're not forced to sell, you're not losing shit. Alright? Now people get emotional when they see that their portfolio goes into the red and they say, oh, it's a bloodbath, I'm losing money. What the hell are you talking about? You're not losing shit. Again, if you're holding good companies and you know the intrinsic value, it doesn't matter the short-term market price. It is irrelevant. So the so-called loss that you see in your account is an illusion. It's like the Matrix. It is not a loss unless you freaking sell. And you shouldn't sell if it's a good company that's making money that will go up over time. In fact, there are many companies right now where the sales are going up, the profits are going up, like Nike. Nike's sales are going up, profits are going up, Adobe's going up, Microsoft's going up. These companies are worth more and more every single day, but the share price is going down. Should you get upset? Of course, because it doesn't matter. It's a freaking illusion, right? So take advantage of the illusion by buying more shares, and if you have no cash to buy more shares, then just ignore the market. This red that you see is an illusion, because once the market sentiment changes, and it changes really fast, and the prices boom, zoom up again, then it's going to all turn green eventually, right? So it is not a loss. Remember, it is not a loss unless you are forced to sell. And if you're holding good companies and you're investing with money that you don't need in the short term, there's no reason to sell, and it's not a loss. I find a lot of retail investors, they break rule number 3, and that's why they lose money. All right, so what's rule number 3? Rule number 3 is this: never make investment decisions. In other words, never buy and sell based on the predictions of experts, whether they are economists, analysts, or YouTubers. And never make investment decisions based on reading news headlines. Now, sometimes when I read the comments in my YouTube channel, people say, Adam, you predicted the market was going to go up and I bought and lost money. You predicted the market was going to go down and I sold and lost money. Well, first of all, I never make any predictions. If you watch all my videos, I always say that, hey, there's a probability the market's going to bounce from here. There's a probability that the market's going to reverse. I always use the word probability because what I say, no one can predict for certain. So that's the first thing to understand. Number 2 is there are other people out there who make predictions. Yes, I know. There are people in the news, in YouTube who say, oh, the market's going to go up, market's going to go down. And if you make buy or sell decisions based on their predictions, you are a freaking idiot. Okay? So never buy and sell based on anyone's predictions. Why? Because no one can predict where the market's going. They are all guessing. It's all based on probability. So you may say, okay, so if I don't buy and sell based on the predictions, based on the news, then what determines if I buy or sell? So that's rule number 5 and rule number 6. So stay tuned, right? But I'll give you a bit of a preview. Your decision to buy and sell a stock is entirely based on your investment plan. It's based on the fundamentals of the individual business. It's based on whether the business is undervalued or overvalued. It's got nothing to do with predictions of where the market is going to go. Okay. Now, I read news as well. I listen to the predictions of all these people as well. But when I listen to all these people or read all the news, it's purely for entertainment purposes. I never make any decisions to buy or sell based on any of these macro news or events. Okay. So here are a few examples why you should never listen to predictions. Even Goldman Sachs, the premier investment bank on Wall Street, I mean, they hire the smartest brains in finance, and they too can't predict the market for certain. No one can, right? So back in June 21st, 2012, Goldman Sachs said, hey, short stocks. Goldman Sachs is recommending their clients build short positions in the S&P 500 due to a weakening domestic economy, right? And what happened when they said to their clients short the stocks? Yep, you bet the market went up, right? Market went up 7%. Now, I don't blame them because, like I said, no one can predict, right? So you should always invest based on the individual business, the fundamentals, right? So if, again, McDonald's is making more and more money, it's a great business. You buy McDonald's if it's undervalued, regardless of market predictions. Sure, McDonald's stock could still go down in the short term, but who cares? If they are selling more and more burgers and fries, they'll go up eventually. And by buying it more at a lower price, you get even higher returns in the future. This was one that happened earlier this year. On the 14th of March, JP Morgan, they had this statement that said, Chinese internet stocks are uninvestable. Okay, so they told people, sell your Chinese stocks, sell your Chinese internet stocks, you can't invest in it. And 2 days later, the stocks went up double-digit returns. Yes, they did go down a bit more after that, but now China has bottomed and China is now coming back, and China is now starting a new bull market. And I'm not surprised that this year China will outperform the US market. Why? Because it's a cycle. Okay, China has underperformed the US in the last few years. China went into a bear market first, so it stands to reason that now that the US is going to a bear market, or in the bear market, China is going out of the bear market. It's always a cycle, all right? And another thing is that never sell based on reading headline news. Look at it. The S&P 500 over this 10-year period went up 495%. But the reality is most investors would not have seen their investments grow at 495% because there's always something in the news that's going to freak them out to sell. Okay, look at all this news. You know, there's a saying that a bull climbs a wall of worry, right? It's when everyone is worried that the bull market keeps continuing, okay? Chrysler GM files for bankruptcy. European sovereign debt crisis. S&P downgrades US government debt. We have got US government shutdown. We have got Ebola virus contagion fears. We have got Brexit over here. We have got Charlottesville. We have got US government shutting down again. S&P 500 enters a bear market right here. The yield curve inverts. The US-China trade war. The Iranian bombing. Emergency Fed injection into the repo market. If you keep reading this kind of crap in the news, you will never have the conviction to hold on to good businesses and allow them to grow your wealth in the long run. So I suggest to most of my students, don't read the news. And if you want to read the news, read it purely for entertainment purposes. But never ever buy and sell based on any news headlines or predictions or opinions of anyone out there. Rule number 4, stock market declines are opportunities to get excited and opportunities to buy. Now, if you think about it, what is the stock market? It is a supermarket of companies where companies are on sale every day at different prices. Now, again, if you go to your local supermarket and everything's on sale, 30-40% discount, you're going to be excited. You're going to buy, right? But the stock market is the only supermarket in the world where people run for the exits when things are on sale. Because most people don't understand the business behind the stock that they bought. They don't understand what the business is worth. They don't understand the intrinsic value of the business. And of course, if you buy a lousy business that's losing money, yeah, I understand you should sell, you should be fearful, right? But again, as an investor, if you buy good companies that are making more and more money every year and they're growing in value, any short-term decline in price should be a reason to get excited to buy more of those kind of businesses. But you have to understand the business. When you understand the business behind a stock, there's no more fear. You think logically and not irrationally like most people. Again, the markets always go up in the long run. We know that. But it doesn't go up in a straight line. It goes down once in a while. It's the nature of the market. And when you know that a market will go down once in a while, you expect it, you don't fear it. You take advantage of it or you ride with it. You know, you accept it. It is part of the game. So how often does a market decline? Well, the market declines 5% or more, roughly about 3 times a year. The market declines 10% or more, about once a year. The market declines 15% or more, once every 3 years. And the market declines 20% or more, that's called a bear market, once every 6 years on average. They are going to happen. No one knows when they're going to happen. Everyone says, I can predict when it's going to happen, but they predict it every year until it happens. A broken clock is right twice a day. But the reality is no one knows exactly when it's going to happen, right? But here's the good news. The good news is that even the big declines called bear markets, they don't last forever. Every bear market will end. It's like winter won't last forever. Winter will end. And following winter is always spring and summer. Following a bear market is always a bull market. And bull markets are always longer and gain more than the temporary falls in the bear markets. It's like after a 29.6% decline over 3 months, the market then went up 816% for the next 12.8 years. After a 44% decline over two 2.1 years, the market went up 108% over the next 5 years. After a 50% decline of 1.3 years, the market went up 350% for the next 9 years. So again, bull markets last longer than bear markets, and they always gain many multiple more than the temporary drop of the bear markets. Now, people are afraid of bear markets because they think, what if I buy and it goes lower? And they always think that I gotta buy at the bottom to make money. No, you don't have to buy at the bottom to make money. Now, think about it. The average bear market drops 35%. That's the average, right? And right now, the market's dropped 25% on the S&P. Now, it's bounced back a bit, but it went all the way down to close to 25%. Now, let's say you bought after a 25% decline, and after you bought, it went down another 10%. Does it really matter? It doesn't really matter if it went down another 10, 15, or 20%. Why? Because ultimately, it's going to go up 2, 3, 4, 500%. So it doesn't matter whether you bought at minus 20 or minus 35. If it's going up many 100% full in the future, it really doesn't matter, right? So I find investors have to get over that. Like, I mean, think about it, right? Let's imagine you bought, what if I told you that if you buy a stock at $50 today, it's gonna be $200 in the next couple of years? Will you be happy? You may say, yeah, sure, I'll be pretty happy from $50 to $200, right? You'd be happy, right? But what if I told you that after you bought it at $50, it dropped to $30 first before going to $200? Will you still be happy? You may say, no, I'm not happy now. Why not? It's the same thing, right? So why do you care that it dropped even more before eventually going up to way above where you bought it, right? And in fact, like I said, as an investor, you never want to invest all at once. You always want to, save a bit every month to put a bit into the markets consistently. So if it drops to 30, you can still add in a bit more to keep averaging your cost down. So eventually when it bounces to 200, you get an even bigger return. So we've covered the first 4 rules. So in the next part of this video, we'll cover the next 4 rules. If you've not already done so, subscribe to my channel so you get the alert once the next part of this video is released. So I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.